Recording. So JP, please kick us off.
Perfect. So excited. Not that it's the last meeting of the year that's virtual. Hopefully I don't know, I'm not going to talk about news and politics at all, but I can tell you it's been an eventful November. And hopefully we'll get a little bit of relaxation next week coming into Thanksgiving. But I think the reason why, and we'll talk about kind of our schedule for the year, we wanted to end off with mergers and acquisitions. That's kind of the end of the life cycle for most of us who sold companies till we go back to this nightmare of starting another company. So that's what really we're going to be diving in today. So before we get started, we're going to give you some awesome news. If you're not a part of the Thai Atlanta community, we're a part of a large global organization. And it has been just astounding year, even though we've had to adjust in so many different ways, as all of us have. We have a very robust middle school program, high school mentoring program, college program, and unbelievably, we've been very well placed over the years, thanks to a lot of our charter members and leadership. We were able to win first place in both categories in high school and in the university program. Amin, can you tell us a little bit about the program and recognize some of the leadership that was involved with those two programs first? Amin, I think you're on mute.
Sorry about that. Yeah, so, if you guys have been following us on email, Twitter, and social, we have, a very robust high school program, as JP mentioned, and all that went virtual this year. And I think one of the things that we were able to mobilize, it's because of the strong community that we have, is mentoring. We knew that, this virtual environment creates an awesome opportunity to engage mentors worldwide and also regional mentors as well. So I think that also is a lot of credit to, again, getting our program winners for high school and university ramped up for the global competition. So it was very exciting. When we won the high school competition, it was just an exciting, moment for us. This is our third time winning the competition in the past 6 years. So, and first place at that. So that was very exciting just because, we had a lot of mentor support from folks like Anir Pradhan, Kanchana Raman, Gopal Korthana, Sankit Patel, JP also participated in a lot of those sessions, Paul Lopez, Arul Morgan. I mean, there were just a lot of great entrepreneurs within the community. Ajay Jindia, who's just joining, also participated. But when we also went for university, it was kind of that same model as just trying to bring together entrepreneurs that wanted to give back, that wanted to help, the upcoming entrepreneurs to be able to, again, refine their business plan, really look at their pitch, look at their financials, and then present them in the light that we want to represent Atlanta with. So excited that we won both. I think that we're the only chapter to do so in a given year, win both competitions. So I kind of call ourselves, in terms of the education that we bring to the table and the mentorship, it really shows that we have a very strong community here in Atlanta.
So following on that amazing success, we were also voted and won best angel investment program in the world through the 60 to 70 chapters globally. And also a huge component of that is our ability to support minority and underrepresented and female founders through the Access program. What's been really exciting with that is, if you don't know about the Thai Access program, it was our effort through the Thai Atlanta Angels to bring our investment community to focus on investing in 3 companies, just under $300,000 of equity capital into these businesses. Really exciting success that we had there. And to tell you a little bit about the very short version of the Thai Atlanta Angels, we've deployed over $7 million in the last couple of years here, 2.5 years or so, and it's been a wild success. So if you're interested, you're looking at angel investing, and you want to participate, we'd love to have you learn more about Thai Atlanta Angels, be an investor as well. And thanks to all of those of you who've been on the support and the committee, Paul Lopez again, Sid Mukherjee, Stephanie Diaz, Amin Helping, Krish Prabhu, Ajay Jindia, Pete Meester. Thanks so much for your support. And also, I know we don't have a slide, I don't think, on this. Amin also won Best Executive Director in the world. So thank you, Amin. A really amazing job. I think he somehow removed that slide off on one of these things here, but congratulations to him as well. And for all the things he's been able to do and adapt in this kind of environment.
So like JP said, a lot of great momentum. We're going to use this momentum now going into next year and setting up, again, another robust calendar. We know that we're going to be doing things in a hybrid fashion. We're also looking to, plan for an opening when we get back to doing events in person. But with that, we definitely want your input. So I'm sending over this link into the chat, but feel free to take a photo of this. But as we plan our calendar for 2021, there's a couple new programs that we're going to implement. But on top of that, we want to ensure that the actual focus is going to be there for the entrepreneurs that we serve. So we're doing some profile collection, seeing which events you attend, and then based on that, really put together our program for 2021. JP, do you want to talk about the workshops real quickly?
Yeah, so what's going to be different next year is we had at TiCon, if you attended, a different approach. Yes, we have great speakers like we're going to have today, valuable insight, breakout sessions talking about these topics. What we want to do is get more into meat of building a company. So instead of just having our moderated panels, we're adding workshops where it's an invite-only, member-only event where you're going to have a guided discussion through the process, going through resources. We'll have a lot of content library created. We're going to create videos. So say, for instance, you're like me and I've gone through the process of raising Series A, Series B several times, and you want to go through the mechanics. How do you negotiate your operating agreement, your term sheet, the subscription documents, what a pro forma needs to look like, what's the financial package look like. We're going to get very tactical and walk entrepreneurs through that entire process step by step rather than just being a discussion. And so it'll be more of a Socratic method for those of you who've gone to kind of like the Harvard case study methodology. We're going to use cases, actually go through businesses. You guys can ask and answer questions about your company relative to accomplishing that phase of your business.
Exactly. So stay tuned for that information. We're going to be rolling it out. But again, an important part of it is to get that survey filled out so that we can better serve our audience. So back to our regularly scheduled programming. We're ending off the year with our fourth quarter. We thoughtfully, with JP's help and the board's help, designed this calendar to really meet all stages, all ages, and all industries. And, now we're actually ending off the year with our fourth quarter topic, M&A and exit prep. So we have a panel lined up that will discuss, but again, we'll be going back to kind of the similar calendar with different topics, but really focusing on the stage of business for 2021 as well. For those that missed out on any of the events, do subscribe to our YouTube channel. Just go to YouTube, Thai Atlanta. This event, along with all the other events that we've covered all year, are there. Also, a few inspirational stories from entrepreneurs, some information about our other programs like University, Angels, that like JP mentioned. All of those kind of snippets, videos, highlights are all on our YouTube channel, so do take a look. And one of the things that we provide as our best, I would say, the best part of being a member with TIE is the access to mentors. So after when the actual panel concludes, we're going to open up breakout rooms. These are going to be your breakout room leads that are going to be on to be able to discuss and extend the conversation that's going to be had at the panel level. So thank you guys for all the folks that are helping with the breakout rooms. Our sponsors, we can't do it without you guys, and they know that. And we'd like to consider them as partners because, they do a lot of work in supporting entrepreneurs through their life cycle, in terms of legal, wealth, accounting, whatever it may be. But these are the folks that we trust and that also participate in our programming as mentors, as subject matter experts, and also participate in these breakout rooms as well to be able to give guidance. So, if you're looking for help, along your entrepreneurial journey and you're looking to really look for that, wealth strategist or accounting strategist that fits into your company, but could also give you some guidance about the ecosystem as well. So thank you to all of our sponsors. I know we have Chitra that's online, Jagruti that's online, Ajay Jindia that's online here as well too, but thank you guys. And as mentioned, because our sponsors are our partners, we have a full library on YouTube that has content that we've developed through them as well too. So this is a lot of useful insights for you guys to know, one about what that given service is doing, and then how is it affecting the climate that we're in now. This is one of the components that we're also going to have for 2021, really working with identifying what are the right topics tactically that we can actually cover with the entrepreneurs and really provide that kind of synergetic connection on being able to be mentored in those specific service industries. So, all right, well, we're going to go ahead and get this panel started. To introduce our moderator and also our sponsor point, Rob, is going to be JP. So JP, please.
Perfect. So thanks again for attending this really exciting event. We had an unfortunate change up. Rachel was unable to, due to some family issues, not able to attend today. So we love Rachel, and she's been a great supporter of the Thai community for a very long time, but we'll be missing her today. But Rob is part of Fifth Third, which is a really exciting organization here in Atlanta, based here. Actually, I think about less than 300 to 500 yards from my office here in Tower Place. They're in the building where Bistro Nico is, in the heart of Buckhead. And I met the team at Fifth Third years ago with a gentleman by the name of Randy Kaporik, who's been an amazing supporter in the Thai community and the entrepreneur community in Atlanta. But Rob is part of that team and heads up the investment banking group. And for the last decades, he's been helping advise public and private M&A activity, capital raising transactions, in just a myriad of industries, and he could probably go through that even a lot more. But under his leadership, their investment banking group has tripled in size over the last 5 years, and they're one of the top leading advisors in the entire mid-market space. Rob has just a tremendous background at top firms like JP Morgan, Jefferies, Robinson Humphrey, Bowles, Howell, Connor and Company. But he's just an amazing person. He did his MBA from Darden and University of Virginia, and Bachelor of Science in Finance from Commerce School at the University of Virginia. And he has his wife and 2 children living here in Atlanta. Rob, thank you so much for moderating the session. All yours.
Well, thank you, JP. And I really appreciate that. Really appreciate being here today representing Fifth Third. Clearly, my wife did not write that bio, because I don't think she's ever called me amazing. So I'll take that as a compliment. But Fifth Third really has enjoyed the partnership with Thai Atlanta. Started this year, kicked off with our economist, Jeff Korzenik. We look forward to the future working with the entrepreneurs in Atlanta. Fifth Third's the 10th largest bank in the country. Business owners and entrepreneurs are core, the majority of our business, and Atlanta is one of our fastest growing markets. As JP said, this topic is really core and near and dear to my heart for many reasons, but one is I do run the investment banking group, which is primarily focused on M&A and exits for business owners. I also started my career in technology banking for JP Morgan back in 1999. And so remember the days where we were taking companies public that business plans on their napkins didn't always end up well, but it was a good learning point as we think about how the market has changed. And as you think about if you're an entrepreneur evaluating an exit, what are those opportunities ahead? And I'm glad we're having this call, this discussion in November and not back in April. Because things are really different now, right? We went through a lot of change, a lot of uncertainty, and a lot of struggles and challenges for a lot of folks and businesses. But the silver lining is the theme around change and opportunity. Change was already happening. I think the pandemic has only accelerated that. So if I'm in your chairs as entrepreneurs, the glass is half full. There's a tremendous amount of opportunity. We believe the economy is on that next wave of growth, which again sets the stage and the foundation for really evaluating those exit alternatives. So with that, I think we got a really good conversation today. I want to introduce our panelists that are going to lead that. So I'm going to hand it over, Jarratt Braxton. Jarratt, I'm going to hand it over to you to give your background.
Thanks. And just this happens a lot, but I'm Braxton Jarrett.
I'm sorry.
Yeah, usually I don't bother to correct because it could be either a first or a last name in both cases. But thank you. Thanks for having me. I appreciate the opportunity to talk with everybody, both panelists and audience. I'm the CEO of a company called Cognosos. Cognosos is an Atlanta-based technology startup. I joined about 6 months ago, and first day on the job, I shut down the office and didn't see a single person for the next 4 months face to face. It's been an interesting experience. We do Internet of Things technologies. So most of you are probably familiar with that broad term, but specifically we have technology that allows us to really cost effectively track assets indoors and outdoors to optimize and make our customers' businesses more efficient and more effective. And a couple of use cases. One that's relevant right now is we sell systems to hospitals that allow them to track all the equipment that moves around a hospital, like ventilators, blood pumps, and other kind of essential equipment that's shared within a hospital. So it makes it easier for nurses and technicians to find equipment when they need to for patient care, and it reduces the overall cost for hospitals because in general they're buying 20 to 50% more equipment than they need because they can't find it, or it's being hoarded, or something like that. So it's a really interesting business. Prior to that, I've had a couple other entrepreneurial experiences that are relevant here. I'll kind of focus on the exits part of it because I think that's the subject of discussion here. So going way back 15 years ago, I was hired at a company called N2 Broadband. It's doing enterprise software for the media technology space. Built that company. I was the head of product marketing, business development, and we sold that to a public company based out of Europe for about 125 million. So that was an interesting kind of rise from a couple million to that. Then we were part of a roll-up of that public company, and we spent a couple of years building that business and sold it to Ericsson for 1.2 billion. Then that gave me the dry powder to start my own company called ClearLeap, another media technology SaaS company. We built that and sold it to IBM about 4 years ago for $250 million. And then I ran the IBM business unit for a couple of years before joining Cognosos. So I've had 3 exits and kind of learned a lot, and hope to share as much as I can with everybody on the panel here.
Fantastic. Thank you, Braxton. Shyam.
Okay, there. No, thank you for having me. Really appreciate being here with all of you. So my background is fairly broad. I started out as a lawyer, spent the entirety of my legal career at Kilpatrick Stockton, Kilpatrick Townsend in town in the Atlanta office, where I did M&A and venture capital and private equity work with specific spikes in interactive marketing, apparel. Did a lot of the corporate work for Adidas, for example, but then did deals for Equifax. So I was in fintech as well. Really good experience. Did that all the way through associate and then partner. I left the partnership during Obama's first term, where I ran the General Services Administration in the Southeast as a presidential appointee. It's about the closest thing you can get to in a business in federal government. Everybody now has heard of GSA because GSA is responsible for transition and for transition, as everybody knows, and ascension, et cetera, or ascertainment. But in any event, that was an interesting experience because I ran an $8 billion supply chain, a 44 million square foot real estate portfolio, and a 41,000 vehicle fleet. We were in 8 states, 12 service centers, over 1,000 employees. So again, like I said, it was a great opportunity to be on the executive leadership side, but also give back through public service. I left the administration at the beginning of the second term to take on a corporate role at a $1 billion international manufacturer. And then I've been at a $3 billion publicly traded wholesale distributor of building products. In both those companies, I've held the chief administrative officer role, where legal, real estate, risk, IT, HR, et cetera, many other groups have reported to me in different iterations. A couple of years ago, I led the acquisition of a $1.4 billion company, $1.3 billion company at BlueLinx, and then quickly transitioned over to be the chief transformation officer, where I led the integration of that target into our core business, which again was a different set of skills and muscles flexed, I guess. In my current role, I run legal, all of the corporate development work, so all M&A activity, as well as HR, real estate, and risk. So big mouthful. Sorry that took so long.
No, awesome. Really good backgrounds. Now I know why I'm a banker, and because I don't have the qualifications to fill those roles. Why don't we dive right in and to the heart of the topic today and think about timing. So early stage companies, can have an exit window that can be 10, even 15 years and beyond. So the first question is around timing. When if you're an entrepreneur, when should you start thinking about an exit? Braxton, I'm going to start that question with you.
I mean, I guess you should start thinking about it, you know, as you're starting your company in some ways. I think, you know, there's a common adage that, you know, you don't build your company for an exit, but the fact is that most venture-backed startups, their exits are, you know, M&A exits. So I think it's worth at least thinking about, you know, what's your path? Is it, you know, going public? Is it M&A? And at least, you know, are you moving into a category that's, you know, interesting enough to have multiple exit opportunities? So I think it's important to at least be thinking about it in the early stages. You know, going forward, obviously the key is you're getting, you know, usually a decent size investment to grow the business. And so there's like, you know, there's at least a couple of years where you want to make sure you're proving your opportunity and growing from it. And I think from there, it just depends on what your outlook is in terms of the upside potential. Every acquisition, it's, you know, they're obviously looking at multiples and comps and things like that, but they're always betting that whatever they're buying is going to get them exponential growth by being inside of the acquisition, if it's an acquisition. And so I think a lot of what you want to be doing is kind of looking at what's your future, you know, total market opportunity, you know, with the trajectory of your business, and making sure that there's still a lot of promise ahead of you and that you're sort of showing this accelerating growth going into a big market. And that could be 2 years, it could be, you know, 10 years. Obviously, you know, most VCs have a window that they're thinking of in the sort of 3 to 5 to 7 year range. And so you want to be aware of what their expected returns and time horizons are. But, you know, it's obviously, once you've started the business, you're expected to grow some real value. And that, you know, that certainly is going to be in the minimum of 2-3 years, and hopefully not as long as, you know, 7, 8, 9.
Excellent. Thank you, Shyam. A little bit of that same question. You know, when you're on the buy side, so reaching out to targets, are they typically part of a process, or does your outreach kind of start that dialogue of having a company think about an exit?
Yeah, I would say for us, just given where we are as a company and the types of companies we're looking at, they're usually in a process. In other words, I would say that a lot of strategic buyers, to the extent that you go to a company without a process, usually have a strategy that says, you know, I either want to expand my product portfolio with these type of products that will address these needs of our customers, because we clearly don't have it. And so you might hire a buy-side banker to go out there and search for companies, or the industry could be so small that you know who they are already. But for the most part, for us, especially because typically anybody we would go to, given the synergistic opportunities, and that's part of this discussion, so I'll talk about that later. Most likely, those companies are going to be in processes that we otherwise become aware of. That said, we know the players in our industry, and our CEO is always just, you know, maintaining good relationships with other corporate leaders, so that if and when the opportunity is right, then there might be a chance to do it outside of a process, which would be ideal for us, right? As a buyer, you want to always do a deal outside of a process, because you're more likely to get kind of more favorable terms.
That's why you might need a banker. We'll get back to that later. I'm going to stick with you and talk about, you know, timing of an exit and how important the environment, you know, comes into play. Clearly, you know, we're in extreme earlier this year where really deal activity fell off a cliff. So if you weren't already engaged in a process, you know, you probably weren't doing anything. And what I tell my clients is, you know, to do a successful exit, you kind of need a good company, you know, in a good industry that's in favor and in a good market environment. You don't necessarily need all three, but to do it really well. So my question for you is how important is that environment, the M&A, the economy, and the M&A deal environment to have a successful exit?
Yeah, look, I think it's really important. I would add one more dimension, and that is it couldn't happen fast enough. So once you're in a deal, it's all about execution as quickly as possible, because, you know, you can go back over time, and let's just take the Fukushima accident in Japan a number of years ago. I mean, there are people I know who literally their debt costs went up by 75 to 100 basis points the day after, and they were a day late on consummating those deals, those debt deals. You could have some other shock, like back in 2008, 9, 10. I was representing a company on the sell side, and they were literally, I mean, we were racing to the exits to get the deal done before the capital markets froze up, and they made it just in the nick of time without losing any multiple off the valuation. So my advice to anybody looking to sell a company is don't let something immaterial get in the way of getting the deal done, because there's always execution risks and exigent circumstance that could arise. But yeah, market conditions make a huge difference. Right now, there's a lot of money, on the sidelines. As crazy as things may seem, I've come to the conclusion that the U.S. is still the best market in the world. We're always the best game in town, and so even when things are bad, more money will pour into the U.S. markets. Fewer deals are being done through public markets. There are half as many companies on the exchanges today as there were in 1996, which means there's a lot of capital in private transactions. And there are certain industries that are, right now you've got, building products, because of this COVID-19, the world I'm in is pretty active and hot. Just in the last week or two, there have been five major building products transactions announced in the last several weeks, ranging from Home Depot buying HD Supply to the BFS BMC merger, and so on and so forth. And of course, healthcare and pharma is big right now because you've got lots of government involvement and government monies in those. So when your industry is hot, whether it's a cyclical or a non-cyclical, it's important to strike when the iron's hot, because that's when your valuations will be greatest. And then the last point I would make is, I'll just use, it's better to have 100% of something you can agree on than 100% of nothing if you're like $500,000 off on your valuation, right? If you're waiting for a little bit of extra money, you could miss your window of opportunity, and then you just gave up, let's say 5 million instead of the 5.5 million you were trying to get.
Braxton, you've been on the sell side several times in your career. It's kind of similar question. Did you have a strategy around that timing of the sale, and was it, as Shyam says, was aligned to that that great market, or was it based off of more of an inbound, and then you kind of reacted and created that opportunity?
I would say for all of them, actually, it was a combination of the general macroeconomics of selling, buying companies, and then whatever sort of thesis the buyers had about why they needed you, and what that ended up creating was this competitive situation on the sell side. So I was shocked a couple of times, and in that the single biggest value increase in the process was not necessarily any metric I had in the business, but the fact that there was 2 or 3 buyers that were interested in the same thing, because the market, their customers, their investors were telling them, you need to have this kind of technology in your portfolio. So, it was kind of funny, because as much as we sort of would spend time making sure we had everything teed up and had the right number of, the right amount of ARR to get a multiple on, it was the single biggest valuation difference from starting the process to the end was not my base of what they were doing the multiple on, but what the multiple was because of the competitive situation. So unfortunately, as an entrepreneur, you can't, you can't necessarily predict that, and you can't certainly, make it happen, but you should definitely be aware of it, because if you're, just like in anything, if there's multiple buyers and limited sellers, that's the single biggest value change that I've seen for any given set of, inputs from the selling company. And that's where you just have to kind of be flexible and think about it. And, when you get unsolicited inbound, you have to have a point of view on whether, you know, that time and that offer is the thing that's going to bring you competition in your deal or not.
Yeah, I would add that in those situations too, especially in the tech space, that sometimes the valuations are sometimes, you know, the customers are saying, hey, you really need this. But a lot of times those valuations could be driven about customer loss. And I need to spend this in order to retain X amount of revenue on top of growing the market share with, or the wallet for this set of customers, which if you as the seller know that strategically, then you along with your banker can truly extract as much economic value out of the deal as possible. And that's striking when the iron's hot is just so important.
Excellent.
Absolutely.
So you guys both talked about valuation. So why don't we go there? Because obviously it's usually the number one topic for owners. I guess, Braxton, my first question to you is how do you know how much your company is worth? Is that something you're leveraging outside advisors to give you views on? And I know each business is different in terms of how they're valued, but maybe some thoughts around valuation in at least in your sector.
Yeah, I mean, right now in the last couple of businesses I've done, you know, it's recurring revenue is you know, the core metric. So, you know, we're a SaaS business and my last one was, and so, you know, a lot of the software tech businesses are trying to build a recurring revenue business. You know, with that, with recurring revenue businesses, a lot of times, you know, the trailing or existing revenue under contract might be low, but if you're growing, it's really the total business under contract that you have. So part of it is making sure that you're sort of selling the right metric in your business based on what the buyers are thinking about. And that was an eye opener for my last business where we might have had you know, the ARR revenue might have been 15 million, but the current business under contract that we could demonstrate going forward was 30 million. So, you know, huge difference in the base of what they're valuing you on. And then from there, the multiples, you know, as most people know, in this kind of business could be anywhere from 8 to 20 or 30x that you know, ARR under contract. So so right now I'm seeing for investors coming in doing an investment, you know, 10 to 20 multiple on ARR under contract is what I'm seeing. It's, you know, the difference between 10 to 20 in an investor is highly based on growth. So are you growing, you know, 50% a year or 500% a year? And that's the difference between those kinds of multiples. On an exit, you know, the trick is, you know, some buyers are going to have to look initially at what their current valuation is based, you know, and then apply that to you with the growth metric. But the bigger the buyer is relative to the seller, they can get aggressive in that multiple because it's not necessarily material to them. They won't have to report it to public markets. So on a sale, you know, you're probably not going to generally get a 20 or 30x multiple on ARR. It's going to be, you know, somewhere in the 10 to 15. How you get it above that is the competition, and then you need to make sure that the buyer understands how they're going to justify that internally, and that is where a banker can help a lot to sort of position you. When a big company wants to buy you, what I've seen is the momentum of them committing internally that they want to buy you is pretty significant, and they become a little bit less price sensitive. And again, in my experience, and are willing to bump up that valuation to close the deal if they think that they would lose it to a big competitor. So I don't know if that answers your question.
It does. And again, this follow up to that in terms of it, when buyers are stretching for those higher multiples, in your experience, how much of that price do they pay up front versus some sort of a future value or earn out type structure?
I mean, that is, again, highly dependent on your negotiating leverage, you know, as the seller. Sellers, you know, never want to try to do earnouts that are tied to something they can't control. So, you know, again, that's once a lot of what happens in both raising money and selling, as I'm sure you know, is, you know, you may get to your maximum valuation that you're going to be able to get out of them. And then it becomes like, what are the terms for things like earnouts or holdbacks or other terms? And so I think, if you feel like you've gotten your maximum valuation, that's where things like earnouts or holdbacks, can be negotiated. So every entrepreneur I know that's had a earnout has lost. I'm sure there are some, but I've never heard of somebody beating their earnout, and in my case, again, I've never even heard of somebody actually achieving the earnout. In almost all cases, it's a disappointment. So what I've been able to do in mine is have, a holdback that is not tied to any metric. It's just it's essentially a retention that's tied to a number of years you're at the business. And that's what I think most buyers, again, in the tech space I'm familiar with, will end up coming to when you negotiate it.
Excellent. Shyam, I know you're currently not focused on the buy side on technology, but but you're an expert on valuation. In terms of future valuing businesses on the future, as Braxton described, versus kind of looking at historical multiple metrics. What's your perspective around that as it relates to valuation?
Yeah, it's it's an interesting question. It totally depends. I mean, in the public markets, you can't, when you do a deal, depending on what your synergies are, the markets will start to value you on your forward-looking earnings based on the synergies you announce arising out of the deal, which is immediate, right? Instead of waiting the 2 to 3 to 4 years. And so long as you continue to hit your targets and you realize your synergies on the timelines that you've provided, then your stock price will hold. And presumably, with time, it will go up even higher than it should have gone up anyway, just because of the way the public markets work. So I think it's really, for me, I think it makes sense to value on synergies because it's generally driven by cost savings. So for example, in my industry, let's say we were buying a company with, same size company, bunch of facilities in the same markets we operate. Well, clearly you've got 3 buckets of synergies out of the blocks. You got G&A, so you don't need 2 CFOs. You don't need 2 CEOs. You've got a lot of other headcount you can probably take out. Then you look at kind of procurement. Well, clearly you've got 2 companies that are maybe working with the same vendors. You combine the spend, and then you get, new programs in place that truly leverage the consolidated spend to extract more savings and rebate programs, discounts, etc. Then you get a second bite of the apple because you can reallocate spend on your 3rd-tier providers into, those preferred providers and get another layer of synergies. And then you've got logistics, right? Let's say you've got 2 facilities in one market, you combine them into just one, you get rid of the real estate, you maybe monetize it and generate some cash off that deal. And then you rationalize your operations so that you're generating more revenue and EBITDA off a much lower cost structure than before. So all of that translates into EBITDA, in a business like ours. And then of course that then factors into the valuation of whether it's 7, 8, 9 times. You put technology and, let's say, healthcare aside, industries are typically in the single digit of earnings multiples. When you start getting into technology, you're looking at double digits. Sometimes it's a multiple of revenue, depending on what the strategy is. Sometimes it's a multiple of what Braxton was talking about. Maybe it's a multiple of earnings. I mean, it just depends. I will say this, it's interesting, being on the customer side of a tech company, there's always a big push to enter into multi-year contracts, right? You can sometimes get really favorable pricing terms if you enter into more years, and it goes right to that point. It's all about recurring revenue. Whereas in other industries, that might not be as important.
Helpful. A good process question came in from our group around finding the right buyer and should you do things in your business to position for those buyers. Braxton, I'm going to start with you. I'm going to assume a lot of earlier stage companies do not have an investment banker. I think there's an investment banker engaged. They're helping the company identify those parties in position for it. But let's assume on this question that there's not an investment banker. So how does a company that wants to exit think about that step of finding the right buyer?
Again, I can speak to my experience, which is, all of my exits were inbound, unsolicited, or at least started with that. So, and in a couple of them, they started with partnerships for distribution or co-marketing or something. So, the last company, we started working with Microsoft on deploying our platform on Azure. And then, a couple other people heard about it, and it quickly turned into an inbound, acquisition opportunity. And then similar process, and frankly, both the other two companies that I sold. So, I again, it highly depends on your industry and what you're doing, but especially, if you're looking at a global, B2B buyer, which are all the big acquirers in the tech space that everybody's heard of, it helps to start building those relationships early, like before you're even thinking about selling. And then in terms of, a banker, I would, we brought a banker in once we were seriously interested in one of the acquisition sort of floats that came about. And then that's what kicked off the process. And as soon as we were interested in sort of the broad strokes of what we were hearing from an acquirer, that was what, got us taking it seriously, hiring a banker and starting that process.
So it sounds like, similar to Ty, and is that networking is really critical in terms of creating those connections and beginning a dialogue. Because a lot of times M&A, doesn't start out from a transaction, right? It starts around a partnership type discussion of understanding businesses. I guess, Braxton, a follow-up from that is in terms of how you leverage. So you got that inbound solicitation. Who are you leveraging either at the company, at the board, or investor, your shareholders, to help you think through that?
Well, I've had so many inbound stuff, in every stage of the companies I've been at. So you're generally the CEO is the first filter. Is this real? Is it even remotely the right time frame? Can I create a competitive buying environment? If I raise another round, would I get an incremental, major incremental bump in value? So I've always been that first filter. Then, and I depending on the stage of the company, I would sort of politely reject 90% of those. It was only when I started feeling confident enough that we could get a value that would be interesting to investors and founders, that I would even sort of think about it. And then from there, I wouldn't generally involve the board until I felt like it was, met a bunch of that criteria that I just mentioned. And I know there's some discussion about bankers down the road, but I believe in building a relationship with bankers way before you would expect to sell. I don't think you should necessarily hire the banker, but I've learned a lot from bankers that are, sort of in the right stage in industry for what I was interested in, and would bounce things off of them as well. So in some cases, I actually would talk to my friendly, couple of bankers that I knew before I would even bring it to the board to see, how real is this? Are there others that are sniffing around? Does my competition also, in the mix? And so I would sort of get to my own point of view about it with my network. And then at some point, once I felt it was real enough, I would talk to the board and tell them, hey, I want to actually, bring a banker in and solicit a couple more potential offers to see if it's interesting.
Great. And Shyam, so your day job is reaching out to companies and forming those relationships. What is your strategy and on that topic of how do companies find the right buyers? How do you do that in your current job?
Yeah, a lot of time, our business it's pretty, you kind of know who all the players are. It's highly fragmented, no doubt. There are all these kind of mom and pops but then there are bigger players. And for us, the synergies are so significant that you focus on the parties that are going to give you great synergies as opposed to, a market presence per se, right? Because In my business, it's low margin, so scale matters. It's all about bit off net sales and just margin. So in that case, we already know everyone. So it's just, like I said, just keeping good relationships going. There are probably certain practices that are fair game when you're out there recruiting talent. Then there are certain things that aren't fair game, and if you kind of go in that direction, then it can put a bad taste in someone's mouth, and they might not be willing to do a deal later. So I think it's all about everybody respecting that we work, live, and breathe in a competitive environment, but doing it the right way. I think the deal we did a few years ago where we bought the $1.3 billion business, we ended up having to get, there was a private equity fund involved, but the founder was still involved with the business, and there were other people involved. And so those relationships proved to be really valuable in getting the deal over the goal line and making it happen. Otherwise, it could have been purely transactional. We could have never agreed on a valuation that both of us would be comfortable with. So in our, to sum up, in our case, it's going out to the folks we already know and just maintaining good relationships with them, and just nurturing them over time. And when the opportunity presents itself, you're in a much better position to do it. One other thing I would add to what Braxton said, I think on the technology side in particular, and even in the sort of brick and mortar world, if you've got an exclusive relationship with a party, whether it's with a supplier or you're the supplier to a customer, those exclusive relationships can be incredibly valuable. So if you invest time and energy in developing those exclusive contractual relationships where you have a certain territory or a certain market, that can be important. Or let's say in the software world, you're viewed as a certified provider. That again connotes significant value if the vendor, like an Adobe or a Microsoft or whoever, limits the folks who can be certified. That can, again, that kind of strategic relationship can add a tremendous amount of value and all of a sudden put you in the crosshairs of a potential buyer. And then once you get that inquiry, as a seller, you should never ever do a one-off. I mean, you need to, if they really want you, then you should get a banker. You should create a market and create the tension to maximize value. That's just how you're going to get the most money, just objectively speaking.
I probably would agree with that, but yeah. So you brought up an interesting comment about on the other side there's a private equity investor. So we've probably glossed over that in terms of thinking about stakeholders and exits. So most of early stage high growth companies have either seed or venture or private equity investors that have obviously have a vested interest in exit. So Braxton, maybe based on your experience, how often is that timing driven by those investors? And then what's the process as a CEO that you use to connect with those investors, that you're on the same page around that timing and what you need to do to the business to prepare?
You mean existing investors, you're saying?
Yeah,
in
existing
an exit
investors.
scenario?
Yeah.
I mean, well, hopefully you have a pretty good relationship with existing investors. I generally, don't want to rely on the bank to sort of broker between me and the investors. But I do think it's important to be aware of the expectations that the investor has. For instance, if you get a growth equity investor who's coming in and putting a lot of money to work, they can be hostile to a sale that might be 6 months after that, even if the IRR is technically, looks pretty good. They're putting lots of money to work and they want lots of returns. So I think, that's one of the factors to think about when you get these inbound things is, how supportive are investors going to be? And it's generally the most recent investor that has the most, kind of question about, would it be better for you to hold on and wait, or is it better to strike while the iron's hot right at this moment? And if you've done your deals right, there's not necessarily veto rights for the new investor, but it's always easier if everybody's sort of on board, when the terms come in the door. So, if you have any control over it, it's better as a CEO founder to be able to make sure everybody comes out of it saying, hey, I got a great return on my investment. I'm happy with what the CEO and the founders did. So that's my preference, and that's helped me get repeat investors and support on, future things. But I do think that's important to understand the motivations of the investor and, what they would consider a good return versus a painful return. And there will be legal and procedural things that are in your documents. But again, I would prefer to have everybody support the exit regardless of, what actually blocking rights they have.
Great. So we got just time check. We got 7 minutes. I'll ask one, Shyam, I'm going to ask you one more kind of process question around due diligence, and then we'll wrap up with a lightning round, the question for both of you. But on due diligence, which we could have a whole topic just on that. But when, just describe kind of in your processes, when does that due diligence, the formal due diligence process start, and kind of why is it so important in the transaction?
Yeah, no, for us, it starts really early, like immediately. So, you sign the NDA to typically get a teaser for the company. Well, you get the teaser for the company that doesn't require an NDA. Then if the teaser looks appealing, you basically sign the NDA in order to get basically a confidential information, a memorandum, a CM, which will give you, the investment banker will have put that together to give you highlights about the business. One of the things I always have to argue about is non-solicit. They typically have these non-solicitive employee provisions in these NDAs, which I always strike because it's when you have a big publicly traded company, you can't necessarily control what a GM may be doing in a local market. And they're not going to otherwise know about the potential transaction anyway. And so the way you get around that is you basically tell the target not to share any employee information with you other than in the aggregate. But we take a look at that. And then if there's a potential deal to be had and you kind of get to the process where they've narrowed it down to just you, or if they have a data room, maybe there are a number of folks they're looking at as potential buyers, you get that level of diligence. But you start as soon as you can, once you've decided it's a good opportunity. And the diligence initially is, you're just your typical diligence request list where you're reviewing their financials, their customer base. No names on customers, no names on suppliers, but you want to see if they have customer concentration, supplier concentration, et cetera, et cetera. You'll do your IP diligence reviews for technology companies, what's in their product pipeline, et cetera. But the point is you start early. You have to, because you've got to get your arms around the seller's perceived valuation of its business.
Yeah, and I'll add that as a company, you want to start earlier than that term sheet. The most extreme diligence I experienced was with this IBM sale where we sold them for $225 million, had about 120 employees, and we got a diligence request list that was 2,700 items. And it was a giant spreadsheet, and each item of the 2,700 had supporting, documents and commentary. And then our first diligence meeting was in a small stadium setting that they rented out, and we had 145 people in a stadium from IBM grilling, the 5 of us on the management team, and their diligence team outnumbered all of our employees. So it was unbelievably, extreme and thorough, and IBM's sort of infamous for it. But the preparation we had done at least made it possible to, begin answering those questions. But I would definitely not underestimate, and at least in the tech spaces I've seen, the amount of work. So if you are starting to take seriously, the idea of selling, you probably want to start to get organized around that stuff. I've known companies that have actually started building a data room as we did, even before you sort of entertain those first offers.
And that's a key theme across M&A is that preparation, and it does typically, for our clients, we tell them to start kind of three plus years ahead of a planned exit, thinking about diligence, thinking about management teams. You know, we didn't even talk about wealth planning, but if you're a high growth company and you're going to have significant value creation in the next 3 years, you really want to be talking to your wealth advisor before that to think about strategies to minimize the potential taxes. All right, last, before we wind up for the breakout sessions is lightning round question. Braxton, for you is if you had a crystal ball looking back on transactions, what's one thing that you wish you would have done in preparing for an exit that would have led to maybe a better deal?
Well, in the last case, held out more, I guess. I could elaborate, but yeah,
So
timing's everything. And go ahead.
So it was timing of holding out from that, or was it just negotiating more as you went through the process?
In our particular case, actually in two of the smaller private exits, if I had been able to somehow wait either amount of time to achieve the revenue or for a even more competitive dynamic, I would have benefited in retrospect. Again, in just my particular couple of cases. I don't know that that's great advice for people, but that's been my experience since it's a lightning round.
Shyam, so similar question, but a little bit different for you is when you've been on another table and deals fail, I mean, they did not get to close. What are one or two of the reasons typically that happens?
If they didn't get to close.
Yeah. So it failed from that perspective, not failed after you bought it and integrated it.
Yeah.
A lot of deals.
Yeah. One of the underlying bases for the valuation fell apart, so for example, you start diving into the financials and you look at how revenue might be booked, or there's some other, maybe the way they, from an accounting standpoint, how leases were treated, for example, there are a whole host of things where all of a sudden you start noticing potential balance sheet and P&L issues. Then you go back and you say, well, based on what I just discovered, your company's worth, 85%, 90% of what you think it is. That can sometimes lead to a deal not closing. There could be personality conflicts once you start getting into it. So there are a whole host. It totally depends on the industry and the circumstances. But it all gets, once you start diving into that diligence, and also look, when you start getting more information, if your initial synergies calculations are off, then all of a sudden that could affect the valuation.
Yep. Well, JP, we've had a really good discussion. I think a lot of topics create some momentum to go into the breakout sessions. I know there were a handful of questions that were asked, but I think those can be followed up in the breakout.
Very exciting. Thanks, everybody. This was absolutely amazing. Rob, Braxton, Shyam, thank you so much for just an amazing presentation. Several of us who've gone through this process, both in small companies and larger enterprises, know it's no walk in the park. So thanks for your guidance and wisdom. So, Amin, can you give us kind of the 1, 2, 3 on our breakout rooms?
Sure. So I have the slides showing up with the room moderators. These are going to be the folks that are going to help guide the discussion. But again, in this virtual environment, our members know that we want to give any and all opportunities for folks to mentor, even if it is virtually. So this is kind of the essence of these breakout rooms. Each of the speakers, some of the mentors within the community are leading these breakout rooms. But again, it's supposed for you guys to meet and greet and also continue the conversation. If you're assigned to a room with the speaker, then, continue the conversation. If there's a thought that you guys had that you want to discuss in an open setting, feel free to do that. So right now I've gone ahead and opened up all the rooms. So all you have to do is click accept. You should see it at the bottom bar of your Zoom, and then you guys can go ahead and head in and start those conversations. And JP and I will be here to help anyone get in as they have any other troubles, but it looks like everyone's getting in just fine. And the breakout rooms will be an hour. Folks that need to drop off, totally okay, but we'll bring back everyone at about 7:20 to close out.